Welcome to the 80/20th principle. For a very long time, the Pareto law, the 80/20th principle, has lumbered the economic scene like an erratic block on the landscape, an empirical law which nobody can explain. Joseph Steindl won the 80/20th principle can and should be used by every intelligent person in their daily life, by every organization, and by every social grouping and form of society. It can help individuals and groups achieve much more, with much less effort. The 80/20th principle can raise personal effectiveness and happiness. It can multiply the profitability of corporations and the effectiveness of any organization. It even holds the key to raising the quality and quantity of public services while cutting their cost. This book, the first ever on the 80/20th principle, too, is written from a burning conviction, validated in personal and business experience, that this principle is one of the best ways of dealing with and transcending the pressures of modern life. What is the 80/20th principle? The 80/20th principle asserts that a minority of causes, inputs, or effort usually lead to a majority of the results, outputs, or rewards. Taken literally, this means that, for example, 80% of what you achieve in your job comes from 20% of the time spent. Thus, for all practical purposes, 4/5 of the effort, a dominant part of it, is largely irrelevant. This is contrary to what people normally expect. So the 80/20th principle states that there is an inbuilt imbalance between causes and results, inputs and outputs, and effort and reward. A good benchmark for this imbalance is provided by the 80/20th relationship. A typical pattern will show that 80% of outputs result from 20% of inputs, that 80% of consequences flow from 20% of causes, or that 80% of results come from 20% of effort. Figure 1 shows these typical patterns. In business, many examples of the 80/20th principle have been validated. 20% of products usually account for about 80% of dollar sales value, so do 20% of customers. 20% of products Oregon customers usually also account for about 80% of an organization's profits. In society, 20% of criminals account for 80% of the value of all crime. 20% of motorists cause 80% of accidents. 20% of those who marry comprise 80% of the divorce statistics. Those who consistently remarry and re-divorce distort the statistics and give a lopsidedly pessimistic impression of the extent of marital fidelity. 20% of children attain 80% of educational qualifications available. In the home, 20% of your carpets are likely to get 80% of the wear. 20% of your clothes will be worn 80% of the time. And if you have an intruder alarm, 80% of the false alarms will be set off by 20% of the possible causes. The internal combustion engine is a great tribute to the 80/20th principle. 80% of the energy is wasted in combustion and only 20% gets to the wheels. This 20% of the input generates 100% of the output. Why the 80/20th principle is so important? The reason that the 80/20th principle is so valuable is that it is counterintuitive. We tend to expect that all causes will have roughly the same significance. That all customers are equally valuable. That every bit of business, every product, and every dollar of sales revenue is as good as another. That all employees in a particular category have roughly equivalent value. That each day or week or year we spend has the same significance. That all our friends have roughly equal value to us. That all inquiries or phone calls should be treated in the same way. That one university is as good as another. That all problems have a large number of causes, so that it is not worth isolating a few key causes. That all opportunities are of roughly equal value, so that we treat them all equally. We tend to assume that 50% of causes Oregon inputs will account for 50% of results Oregon outputs. There seems to be a natural, almost democratic, expectation that causes and results are generally equally balanced. And, of course, sometimes they are. But this 50/50 fallacy is one of the most inaccurate and harmful, as well as the most deeply rooted, of our mental maps. The 80/20th principle asserts that when two sets of data, relating to causes and results, can be examined and analyzed, the most likely result is that there will be a pattern of, the imbalance may be 65/35, 70/30, 75/25, 80/20, 95/5, or 99.9/0.1, or any set of numbers in between. However, the two numbers in the comparison don't have to add up to 100. The 80/20th principle also asserts that when we know the true relationship, we are likely to be surprised at how unbalanced it is. Whatever the actual level of imbalance, it is likely to exceed our prior estimate. Executives may suspect that some customers and some products are more profitable than others, but when the extent of the difference is proved, they are likely to be surprised and sometimes dumbfounded. Teachers may know that the majority of their disciplinary troubles or most truancy arises from a minority of pupils, but if records are analyzed, the extent of the imbalance will probably be larger than expected. We may feel that some of our time is more valuable than the rest, but if we measure inputs and outputs, the disparity can still stun us. Why should you care about the 80/20th principle? Whether you realize it or not, the principle applies to your life, to your social world, and to the place where you work. Understanding the 80/20th principle gives you great insight into what is really happening in the world around you. The overriding message of this book is that our daily lives can be greatly improved by using the 80/20th principle. Each individual can be more effective and happier. Each profit-seeking corporation can become very much more profitable. Each nonprofit organization can also deliver much more useful outputs. Every government can ensure that its citizens benefit much more from its existence. For everyone and every institution, it is possible to obtain much more that is of value, and avoid what has negative value, with much less input of effort, expense, or investment. At the heart of this progress is a process of substitution. Resources that have weak effects in any particular use are not used, or are used sparingly. Resources that have powerful effects are used as much as possible. Every resource is ideally used where it has the greatest value. Wherever possible, weak resources are developed so that they can mimic the behavior of the stronger resources. Business and markets have used this process, to great effect, for hundreds of years. The French economist J.B. Say coined the word around 1800, saying that the entrepreneur shifts economic resources out of an area of lower productivity into an area of higher productivity and yield. But one fascinating implication of the 80-20th principle is how far businesses and markets still are from producing optimal solutions. For example, the 80-20th principle asserts that 20% of products Oregon customers or employees are really responsible for about 80% of profits. If this is true, and detailed investigations usually confirm that some such very unbalanced pattern exists, the state of affairs implied is very far from being efficient or optimal. The implication is that 80% of products Oregon customers or employees are only contributing 20% of profits. That there is great waste. That the most powerful resources of the company are being held back by a majority of much less effective resources. That profits could be multiplied if more of the best sort of products could be sold, employees hired, or customers attracted, or convinced to buy more from the firm. In this kind of situation, one might well ask, why continue to make the 80% of products that only generate 20% of profits? Companies rarely ask these questions, perhaps because to answer them would mean very radical action. To stop doing 4/5 of what you are doing is not a trivial change. What J.B. Say called the work of entrepreneurs, modern financiers call arbitrage. International financial markets are very quick to correct anomalies in valuation, for example between exchange rates. But business organizations and individuals are generally very poor at this sort of entrepreneurship or arbitrage, at shifting resources from where they have weak results to where they have powerful results, or at cutting off low-value resources and buying more high-value resources. Most of the time, we do not realize the extent to which some resources, but only a small minority, are superproductive, what Joseph Huron called the vital few, while the majority, the trivial many, exhibit little productivity or else actually have negative value. If we did realize the difference between the vital few and the trivial many in all aspects of our lives, and if we did something about it, we could multiply anything that we valued. The Pareto principle, also known as the 80-20th rule, the law of the vital few, or the principle of factor sparsity, 1-2 states that, for many events, roughly 80% of the effects come from 20% of the causes. Management consultant Joseph M. Huron suggested the principle and named it after Italian economist Vilfredo Pareto, who noted the 80-20th connection while at the University of Lausanne in 1896, as published in his first work, Cours d'économie politique. In it, Pareto showed that approximately 80% of the land in Italy was owned by 20% of the population. It is an axiom of business management that 80% of sales come from 20% of clients. 4. Mathematically, the 80-20th rule is roughly followed by a power law distribution, also known as a Pareto distribution, for a particular set of parameters, and many natural phenomena have been shown empirically to exhibit such a distribution. 5. The Pareto principle is only tangentially related to Pareto efficiency. Pareto developed both concepts in the context of the distribution of income and wealth among the population.